So welcome everyone to this early morning meeting. This is the second session. Last month we had an intro meeting. Those of you that didn't attend, it was more of an overview of our 10-part, the 10 questions that every business leader should know. And so this is really the meat of the first meeting, the meat of the matter here. And thank you for coming. Just a couple of housekeeping ideas, options. Restrooms are upstairs. You already know where the coffee is. Food is here, and we want this to be interactive. So how this came about, we had a group of professionals that got together and thought, this is something that I think the community, really the business leaders need. And so I want to introduce our core members, those of the core members that are here today. So I haven't seen Brian. Is Brian here? Van Haas, right here. Let's see, Rich. Paul McLean.
Hi everyone.
Mark Melton.
Hello.
And then we have our two presenters today. So Tom Olson, for our first presenter. Tom is with Nassif Hicks Harris and Company. And I just heard that he just got promoted to partner as of January 1, so congratulations. So Tom is a CPA, and he's a UCSB graduate of Gauchos. And our second presenter is Robert Forzande, and Robert is a partner at Riker, Fowl, Pyle, and McCroy, and he's been with the firm since 2009. And he's a UC Hastings of College Law in San Francisco grad. So I'm going to turn that over to the two of you, and we want this to be an interactive session. So thank you.
Thank you, Susan. Thank you everyone for coming this morning. What I think our goal today is going through the 4 stages of a business and talking about legal and accounting aspects of that. So what we're going to start off with is talking about whether or not the idea of forming an entity is the right thing for your type of business, right? Some of you might be sole proprietors currently with the DBA, whether they make that transition to a corporate entity or not. And we'll talk about that first. Then we'll talk about, if it is the right thing, what type of entity is right for you. Now, I know there's a lot of different entity types out there. We're going to focus today just on corporations and LLCs, because that should cover about 95% of you. There's other things like general partnerships, limited liability partnerships. Those are more specialized niche things that are more upper division type stuff. Not really a good thing for a general topic like today. So once we cover that, then for those of you who are already in an entity, we talk about some of the pitfalls to avoid when you're operating that entity, and there's plenty of them. Talk about those, and then also if it's maybe you're in one and you need to switch to the other, whether that's a proper fit as well. And then lastly, we talk about once you get up to cruising altitude, what to do to then take the operation to the next level. So with that, we'll get started with, is the company even necessary? Now, why do people form an entity? What's the purpose of that? Well, obviously, the first and foremost is liability protection, right? Everybody always talks about liability protection. The entity is a separate and distinct legal thing. It's a separate and distinct human being almost, and I hate to say it that way, but that's really what it is. An entity is something by itself, independent and separate from its owners, from its shareholders or from its members, right? The purpose of that then is to create this barrier, this liability protection between the assets, the liabilities, and everything of the business from the assets and liabilities of its shareholders and of its members. And when I say distinct entity, I want you to keep that in mind, because we're going to keep coming back to that throughout the course of today. Now, when we talk about liability protection, if you're in a business where you can just insure yourself out of trouble, then an entity might not be appropriate for you. It might not be necessary. You don't have to go through all the logistics and all the hard work of going through it, if you can insure around it. So let me give you a quick, simple example of something like that. Say you own like a 10-plex, right? You own one apartment complex, You derive your income from that, you rent it out, that's all you do, right? You can insure your way out of that, right? You can insure against the trip and falls, you can insure against, property damage, you can insure against, renter liability issues. So at the end of the day, you might not need to go through the entity protection as long as you have the proper insurance coverage in place. Now, obviously, if you have multiple properties, then it becomes another issue because you don't want the assets and the liabilities of one to be affected by the other. But if it's just something simple like that, maybe not necessary to do and go through all that whole ordeal of building an LLC or a corporation. So that's just one example. But for the most part, most of the time, forming an entity for the liability protection is important. And it's something that you want to keep in consideration because, again, if something happens to the company, they're not coming after the shareholders for their personal assets. They're not coming after their personal stuff. They're going after the liabilities and the assets of the company holding. So that's an important distinction. That's why most people look to form a company. Now, second is anonymity, right? So like we keep saying, the entity is a separate, distinct thing. It's ABC Corp, ABC LLC. The identity of its shareholders and the identity of its members are not generally available to the public, right? This is especially essential when you have investors. Most investors don't want people to know what they're investing in. They want that protection. They want to be able to invest and know that, no one's going to know their business. And that's what the LLC and the corporation can provide, is that level of anonymity. You have to get a subpoena or some sort of you have to go through some legal process in order to find out the identity of the members or their shareholders. So that's the second. Now the third one is when you have multiple owners or when you're going to have investors. You can't do that by yourself. You need to have an entity or a vehicle, and that's what I'll hand over to Tom to explain.
Thank you. So how many owners or investors you have or intend to have may have a big impact on whether you want an entity or not. If you're just a single owner, you have a lot of options. You can do a sole proprietorship, you can do LLCs, corporations, S corps. You have pretty much the whole gamut available to you. When you're multiple owners, it's a little different. So if you're just a single owner and you can insure against the liability issues, like Robert had mentioned, you might want to consider a sole proprietorship. The reason being is they're simple, and that's what's great about them. They're very straightforward. They don't require that you keep formal books and records. Although, as a CPA, I'm going to recommend against not keeping formal books and records because there's just a lot of things that are necessary. We use double entry accounting. That means we're keeping track of everything. We know what we can say with certainty that we've captured all the income and expenses and all the liabilities and assets. So, like I said, not required, but I would recommend it. Also, they're very straightforward to run, simple, and then they don't require an additional tax return. All of these entities, if you do form one, will require an additional tax return. Your sole proprietorship will not. It will go on a Schedule C on your individual tax return, and all the items of income and expense will then flow through to the front of your tax return, and you will pay tax at your individual level, or at your individual rate, I'm sorry. So that's what's great about those. They're simple, no additional tax returns. What's not so great about them is there's no withholding on the income that you're earning, that your business is earning. So you got to be careful there. You're gonna have to make estimated taxes because you don't want to get to the end of the year and find out, oh shoot, I never paid any money in, and now I have this big chunk. And they're also subject to self-employment tax. Those two things catch a lot of new business owners off guard. They weren't expecting it. They just said, oh, well, I made this money, it's mine, the taxes can't be that much at the end of the year, right? That one's a scary one. I've had some really tough conversations with people once we get to that point, so that's something you should be cognizant of. So let's say you're actually not a single owner, but you intend to have multiple owners, and you know that that's going to be part of your business plan. Well, now most likely you're going to want an entity, because there's a few reasons. First of all, you're going to want liability protection. You don't want the other individuals going out and doing something crazy and holding you responsible for it, so you want that liability protection. You're also going to want to, when you form an entity, you're also going to put together an operating agreement for the entity. and that's really going to help dictate how the entity is going to be run. How is income going to be allocated? How and when are distributions going to be made? What are the voting rights of all the individuals? And also any additional provisions that you want in place when you're operating the company. So, now that you know all that, the question becomes, do you need an entity? So, there are a couple different types of entities. There's actually a lot of different types. We're not going to go into all of those right now. The ones we are going to talk about are C Corps, S Corps, and limited liability companies, because that's probably what you're going to see 90% of the time of our as a CPA of my clients. The vast majority are one of these three entity types, and I don't know what all of your businesses are here today, but most likely it would fit best in one of those three types. So now that we know what those three types are,
So the between the two, it's good to see a little bit of the history between corporations and LLCs. Corporations have been around since the 1600s. It's a very antiquated form of governance of a business. It's very formal. It's very typical of something from the 1600s, right? So about 30 years ago now, legislatures in various states decided to come up with something new, something more informal, something more flexible that allowed smaller or medium-sized businesses, more family-type businesses to be able to operate, but without all of the formalistic, strict, rigid requirements of a corporation. And that's where the limited liability company was originated from. So with that history in mind, obviously, we can see where I'm going with this. Corporations, extremely inflexible, right? You have to have an annual meeting. You have to keep minutes. You have to have, officers, board members, et cetera, et cetera, et cetera. All of these things have to be done. So for those of you who might be in a single member or single shareholder corporation, you think the idea of, well, I need to hold a meeting by myself, call the meeting to order, have minutes of what I did with myself, and then log those things. I mean, it sounds so archaic, but it has to be done. And when we get to the pitfall section, we'll talk about why you have to do that, even though it seems so silly, right? You have to document things to yourself. I mean, it just doesn't make sense. I mean, even if it's, you and your wife or you and another family member, same thing. You still have to be doing these things. Now, the LLC is a little bit different. LLC doesn't require annual, meetings. It doesn't even require any meetings. It doesn't even require a written operating agreement to be in place. All you need is just to file your articles of organization, and that's it. So it's a much more flexible system, and as Tom will explain later, it's much more flexible with how you divide profits, how you divide ownership interests, all of the above. So it's a totally, the two are night and day differences between each other. Now, the corporation is governed by something called the bylaws, the corporate bylaws. You gotta have those in place. And that'll explain everything about, what the voting rights are, when do you need to get votes from, shareholders, how many votes are needed, how do you elect directors, et cetera, et cetera. The LLC, on the other hand, is governed by something called an operating agreement, which Tom alluded to earlier. But again, the operating agreement isn't even required. You don't even need to have a written operating agreement. But I'll tell you right now, if you don't have a written operating agreement, Tom and I are going to jump across the table and strangle you. I mean, it's the stupidest thing ever. I mean, if you're going to form one of these things, you got to have the paperwork to back it up. So now you're probably wondering, you're saying, well, why would you pick a corporation then? There's no point. It's just this old, rigid thing that adds so much more logistics and steps to my business. Why doesn't everybody just pick an LLC? Well, it's the tax issue that makes a big difference, and it's the investor issue that makes a big difference, and that's where Tom's going to step in to tell you a little bit about why sometimes a corporation might be the better option.
So right now up here it says corporation versus LLC. I'm going to actually switch it up a little bit on you. I know that's how we started, corporation versus LLC, but when we jump into the tax realm, that analogy doesn't work as well. The reason being is that there's two types of corporations. Generally, there's two types of corporations, and you'll notice I'll use that word generally a fair amount today. The reason being is in accounting, there's always the rule, then there's the exception to the rule, and then there's the exception to the exception. So I'll use generally, you can use that for the most part, but just note that there will be some exceptions. So for corporations, there's two main types of corporations. It's going to be your C corporation and your S corporation. And how they operate from a tax perspective is different. One is a non-pass-through entity and one is a pass-through entity. So I'm going to switch it up and I'm going to switch this to pass-through entities versus non-pass-through entities. So your pass-through entities are your sole proprietorship, although your sole proprietor is not a traditional pass-through entity. I'm putting it in this category because, again, all the income and expenses are being reported on your personal return. Limited liability companies and S-corps are your pass-through entities. So I'm going to take a slight detour right now because I know probably there's a few people in the room who are not familiar with pass-through entities and how they work and why they're beneficial. So I'm going to take us on a little quick tour of how pass-through entities work so you can be a little more familiar, so you're cognizant of what's going on and why we're referring to them and why it's important later going forward. So this is an example of your single owner pass-through entity. Your single owner pass-through entity, the entity is going to generate income, expenses, and other deductions and tax attributes. 100% all of these income, expenses, other tax attributes will be reported on the pass-through company's tax return. The pass-through company will not pay taxes at the entity level. What that means is you're going to have an entity that is going to file a tax return, but it's not going to pay taxes, well, for the most part. You'll see a little later on that might not be completely true. But just for the moment, no taxes paid at this entity level. What happens next? The entity generates a tax return. As part of that tax return, it'll generate what's called a K-1. Some of you may be familiar with the K-1 term. And what's happening with the K-1 is it's taking all the information regarding income, expenses, and the other tax attributes, and it's passing them down to you as an individual. So as an individual, you'll receive a K-1. It'll have a bunch of different numbers on it. That'll go onto your personal tax return, and then you will pay taxes at it on your individual level. So what does that mean? It means that all these income and expenses that are being generated up here and get passed through to you, you pay tax on those at your individual rate. So two people in this room may have different individual rates because of where they are in the tax bracket, so they'll be being different amounts on that amount of income. Well, that's something to keep in mind. So then go to multi-owner pass-through entities. So how do those work? Well, they start in the exact same spot, which is the entity generates income, expenses, and other tax attributes. 100% of those income expenses are reported on the pass-through company's tax return. Again, no tax at the entity level. Those items are passed through to, interesting, a third. So this company is owned a third by each one of those, by each of the companies own a third by each individual owner. That means a third is passed out to each of the individuals. That means you get a third, owner 2 gets a third, and owner 3 gets a third. An example would be, let's say your company generates $30,000 of net income in the first year. $10,000 of net income will be passed out to you individually, and you will pay tax at your individual level. So basically what's happening, everything is just going straight through the company and going onto your return. If you own it 100%, all of those things will be reported on your individual return. If you own some percentage of the company that's less than 100%, that percentage will be allocated to you. So what are our non-pass-through entities? Our non-pass-through entities are C corporations. So how does a C corporation or a non-pass-through entity work? Well, again, we always start with the first step, which is the company will generate income, expenses, and other tax attributes. 100% of those income and expenses will be reported on the non-pass-through company's tax return. And the company will then pay tax at that level. What that means is, let's say you have a C Corp, it generates $100,000 of net income. Let's assume a 35% tax rate. You're going to pay $35,000 of tax at the entity level. So there's about $65,000 sitting in the bank account at the end of the year. You say, okay, great, except for now it's in the company and I want the money myself because I'm the owner, right? I want to take some of that money out that company generated. Well, You can do that. You can take a dividend. Some of you might already be reporting dividends on your return. So you take a dividend out of the company and you get to pay tax on it again. Sweet, right? So this is pretty much the major downside of C corporations. They provide a lot of liability protection. There's a lot of reasons you might want one. From a tax perspective, I don't ever want one. I feel like they're tax inefficient. It just costs you a lot of money to get from here to here. And so generally I'm going to try and avoid this structure unless there's a really good reason. And you'll see later on there are good reasons for this, but from a tax perspective it's just not an efficient way of doing things. So what are the tax benefits of these pass-through versus non-pass-through entities? Well, pass-through entities, like I said, the tax attributes are recognized by the owners. Well, why is that beneficial? Why is being able to report all of the income and expenses of the company on your personal tax return? That doesn't seem like it has a natural benefit. But to me, that's one of the most powerful things I'll talk about today. And the reason being is that you can do a lot of planning. Decisions you make at the entity level can affect your individual tax return. Think about that for a second. Your company can make a decision that can help reduce your personal tax liability. So, let's see, what's an example of that? Let's say that you have a big income item coming under your personal return and you know that that's happening this year because whatever event is happening in your personal life. And you say, geez, man, if I can generate more losses on my entity level, or even possibly generate a net loss at the entity level, I can offset the income on my personal return. That means I can be net neutral tax-wise with that big income item. So that's pretty powerful. And then the opposite is true as well. Let's say in a particular year you have a lot of capital losses. Let's say you have a brokerage account, you owned, I don't know, Apple, and you happened to sell when it was down, you took a big old capital loss. On your personal tax return, traditionally you would only be able to take $3,000 in that current year, and you can only take $3,000 going forward. If you had the ability to generate a large capital gain on your entity, it would pass through and you could offset those two and be able to take advantage of the loss in that year. So that's an incredibly powerful point, and it's one of the reasons that as a CPA firm and as myself, we try and get people into these pass-through entities if they make sense, because it just gives us a lot of opportunity to do a lot of things. Distributions generally are non-taxable, so once you want to take that money out, you don't have to pay that second layer tax. You just take it out whenever you want it. And then there are other methods for allocating income, excluding S-corps. Again, those corporations are pretty rigid. When I said no tax at the entity level, not completely true. There is some tax. Your LLCs, all of them will have an $800 minimum fee, but your LLCs will be based on gross receipts. Your S-corps are 1.5% of net income, so there is some tax there, and that might make an effect on which entity type you go with. For S-corps, distributions are required to be pro rata. That means we have an S-corp together. Robert and I have an S-corp. I'm 50% your owner and you're 50% owner. I take $10,000 out. He has to take $10,000 out. It is mandatory. We don't get to take different amounts out. We have to take our pro rata distribution according to our ownership. And distributions can have complex rules. I'm not going to go into them, but I just want you to be cognizant of them because there's kind of like a skin in the game rule where you can't be taking out more than you've actually been putting in. I won't go too much in that. Just be aware that that kind of exists for the pass-throughs. Non-pass-throughs. Pros, not much. There's not a lot of great tax attributes for a C corporation. There's this thing called it's called the 1202 exclusion. If you start up a corporation, hold it for 5 years, and then sell it, you sell the stock, you potentially can have 100%. Depends on what year you started it. A gain exclusion from federal tax. There's a lot of rules around that. I just wanted to throw that out there because I was really stretching to find good reasons to have a C corp from tax perspective. And there's also ordinary loss treatment on the sale of stock. So traditionally, when you sell stock at a loss, it's a capital loss. If it was from a small business, you can potentially take an ordinary loss. Let's hope you never have to use that one. So, What are the cons for the pass-through entities? Well, double taxation, brutal, right? 2 levels of tax, you're paying tax twice. What else is there? Oh yeah, double taxation. That's not good. And did I mention that there's double taxation? So clearly, double taxation is a huge negative from a tax perspective because it really limits your ability to get money out of the company efficiently and from a tax perspective. So, oh yeah, potential tax on distribution of assets. This is a concept that isn't playing too much into what we're talking about today, but just think about it. Sometimes when we want to get really clever with these entity types and we want to start pushing assets between companies, not being able to take them out effectively can be a big hindrance to some tax planning. So just keep that in the back of your mind. So, flexibility. In general, so I'm going to switch back here. I was talking about pass-throughs versus non-pass-throughs. Now I'm going to go back to corporations versus limited liability companies. Limited liability companies are incredibly flexible. These things are amazing. They can do so many things. One of the coolest things I think that they can do is this. Change the amount of income that is allocated to the owners. These are owned a third, a third, a third. The company is owned a third, a third, a third. But we've changed that allocation of income to 70, 15, 15. That's incredibly powerful. You can write into your operating agreement how you want to do this. As long as it has substantial economic effect, basically means it makes sense why you're doing this, you can do this. So a great example is, I'll use a CPA firm. Let's say there's 10 of us, someone drives, $1 million of billings, and the rest of us drive $10,000 of billings each. The person who drove $1 million of billings is going to be like, hey, I want that income allocated to me. So that's what's incredibly powerful about these. Again, the ability to put in assets in and take assets out of the company without it being a taxable event is incredibly powerful. I know that doesn't seem like something that you're like, oh, why would I be putting assets into my company and taking them out? That doesn't make sense. Why would I want to do that? There's actually a lot of good reasons. I won't go into them now, but that just I wanted to add this because it's a really powerful point as well, is that sometimes you do want to take those assets out in corporations. If they have appreciated, you're going to run into taxes. So it's going to prohibit you from doing some of this more higher level tax planning kind of thing. So that's something you think about. If that's ever going to be an issue you're going to come across, you might want to go with an LLC versus a corporation. So what type of entity is appropriate for you? Well, I don't know. I don't know what each kind of company you guys have is. I don't know what all the circumstances are, but I can give you some ideas of what might be appropriate for you. So it depends on your business plan. Does your business plan include potential investors? Sometimes investors don't want entities that pass through income and expenses. A lot of your angel investors or private equity companies won't want that. You have to imagine these people are investing in 10, 15, 20, 100 companies. That would mean they'd be getting all of those K1s and their tax returns would be outrageous. So they're going to want to invest in the C Corps. They put their money in, it stays, they don't have to worry about the things flowing out to them. Your exit plan will play into this. If you intend to sell stock, again, that 1202 might be really powerful. The number and types, there's certain limitations on S Corps, how many investors they have, and then there's some, obviously the sole proprietor, you can only have one person in there. Single member LLCs are pretty flexible, you can have all kinds of members and investors. Are there going to be multiple contribution and distribution events? You'll want to think about that as well. So there's a lot of things going through what type of entity you might choose. So now that we know what type of entity it might be,
This is where the problems come up. This is where small and medium-sized businesses run into the most problem. Keep talking about this distinct legal entity issue. Most people don't understand that concept and they abuse that concept, and this is where the problems come up. So it's not your company, right? You might be the sole shareholder, you might be the sole member, it might be a family business, whatever, but it's not. This is a separate company with its own soul, its own being, its own existence. It needs to be treated that way. So just because you're the only person who owns it doesn't change that effect. So it's not your piggy bank, right? It's not your piggy bank. You can't just raid the coffers and take whatever you want and use it for your own stuff because it's my own company. It doesn't work that way. So what happens is, if you stop treating the company like a separate entity, well then the law will also stop treating it as a separate entity. Some of you may have heard the term piercing the corporate veil. As a small and medium-sized business owner, this should be the most terrifying thing, other than drive-by ADA and labor litigation, that you'll ever hear, okay, is piercing the corporate veil. Okay, what that means is if you don't respect the boundary between, if you don't respect the boundary between you and this separate, distinct legal entity, then the law won't either. So what did we show you earlier, that chart which kept everything separate? Well, then all of a sudden you're deemed as the alter ego of the corporation or of the LLC, and then all of its debts, all of its liabilities, all the judgments against it are yours. They're coming after you personally. They're coming after your house. They're coming after your car. So that is the essential thing that you can't screw up. The best example I can give is when you work for this LLC or this company, you just have to assume it's IBM. You're working for IBM, right? I mean, yes, you're the only shareholder, but it's IBM. What would IBM do if you did this to their stuff? They'd probably be pissed off. Don't do it. Right? So if you look at it that way, instead of this is my company, that's the easiest way to theoretically think, well, what I'm about to do, is this right or wrong thing? Now, let me give you some of the examples of when courts or the legal system will frown upon actions and look to pierce the corporate veil. The list is extremely long, but there's some that are more common and that will raise the red flag faster. First and foremost is commingling funds. Right? I mean, hopefully, for those of you who have entities, you have a separate account. There's a corporate account, right? If you're taking money back and forth between your personal account and that corporate account, that's the first thing that's going to get you nailed, right? Oh, I was out, needed to do my dry cleaning, didn't have my personal card, so I just pulled the corporate card and swiped it. Or, oh, I need an extra $2,000 this week, so I just transferred money over from the corporate account, used it, and then, I sent it back a couple days later. That type of commingling, when it's not for like a salary or it's not like a scheduled distribution or a dividend, when that kind of stuff, that's going to raise the red flag. Also, like let's use another example. You had a good quarter, you're expecting to get a dividend or a distribution of, say, $10,000 from your company at the end of the quarter, right? You're planning on taking a family vacation, that's going to cost about $10,000. You're like, well, why should I then transfer the money from the company that belongs to me to myself and then pay for the trip? So you just use the corporate card and book that $10,000 trip on Expedia. Can't do that, right? What would IBM say if you booked the trip on their card? They'd be pretty pissed off, right? You can't do that. Transfer the money over, do the extra step, get your dividend, get your distribution, then with your personal funds, book your trip. Next is using company assets for personal uses. An easy one I can think of on this is in the contractor world, right? You own a construction company or contracting firm. You want to do some improvements at your house. You have the company bring out its laborers, its materials, and build your house, or improve your house or do whatever to your house, and then you don't reimburse the company for any of it. I mean, you're like, well, it's my company. Why am I going to reimburse myself? Well, no, but again, it's a distinct legal entity. So you're at least, reimbursing the company for the cost of the labor. You don't have to give profit and overhead, but at least reimburse for the hard costs that were incurred, right? Don't abuse the separate entity. Next is lack of insurance, right? This is huge. You're like, oh, I got liability protection. Why do I need insurance? They can't come after me. If things go south, the company goes down in flames and south. Well, no, you have to have insurance because any rational, prudent business would have insurance. And you have to have enough of it. Can't just be the, dinky-dink coverage. I mean, we had a client who sold used airplanes. They got coverage of $50,000, right? They sold an airplane to a guy who took up a doctor who was a preeminent doctor in his region, and they crashed the plane. The guy was making $1 million a year. You think $50,000 and he had like 3 kids. Do you think $50,000 and I mean, it's funny to laugh, the guy's dead, but do you think $50,000 in coverage is sufficient? Absolutely not, right? So the type of insurance needs to be sufficient, and then the amount of insurance needs to be sufficient to match what the business is doing. Something along those lines is lack of capitalization as well, right? If you're making $10,000 in net profit every month, you can't take out $9,985 of it as your salary and leave $15 in the corporate account every month. That just, again, would a rational, real business do that? Absolutely not. There needs to be operating reserves. There needs to be sufficient capital to operate the business for whatever it is that it's doing. Then next is lack of the corporate formalities. I was talking earlier about having those meetings, the annual meetings, the minutes of the meetings, the evidence of corporate action. Those all need to be documented. Again, if you stop doing that, this is where the courts will say, well, look, you weren't treating this as a separate legal entity. You were treating it as your own little side gig. Therefore, you're its alter ego. Don't want to do that. So, with a corporation, yeah, keep the minutes, keep the meetings, make them happen. With the LLCs, anytime you do some sort of entity level action, document it. I mean, and I know it's kind of silly where it's you're the only person, but still, and you're signing it on both sides. You're signing it as the managing member and then as whatever. You got to do it. You got to have these things documented. And again, the example of that husband and wife airline business or airplane business comes into play. Again, they had a corporation. They brought in their shiny black leather corporate book that we all have seen, and I opened it up and it was completely blank. Right? They hadn't done anything. No minutes, no meetings, no nothing. And when it came time for this situation elsewhere to be dealt with, it was pretty obvious that there's going to be a corporate veil that's going to get pierced because you're using the corporate card for groceries, for dry cleaning, for all sorts of lunches that had no business component to them. You got to follow the rules. You got to follow the formalities. Now, how do you do it right? Right? How do we do it right so that that doesn't happen? When you're paying yourself a salary, you should have a written employment agreement with yourself, right? You shouldn't just say unilaterally and arbitrarily pick what your salary is going to be. And I know, again, if you're a sole owner of this business, it's kind of silly where you have an employment agreement where you're signing it as CEO and then you're also signing it as employee. I mean, it's a contract with yourself. It sounds stupid, but you got to do it. Just do it because otherwise you're going to say, what's this money going back and forth all the time? You have this document that says this is my salary. It just backs it up. Same thing with distributions and dividends, right? Don't just take out like $200 randomly and say, oh, that was a distribution, right? It's got to be all legit, on a consistent basis, whether it's monthly, semi-monthly, quarterly, semi-annually, whatever it is. Have it be consistent and have the amounts be somewhat consistent with how the performance of the business is. Again, if you're $2,000 short, this month or whatever, you would need to transfer the money. Don't do it just simply for that purpose. It needs to be documented out properly. If you're loaning money to and from the company, same thing. I mean, sometimes, there needs to be a capital infusion, you loan money, or sometimes you need money for yourself personally and you want to take it out of the business. Again, it's got to be documented, it's got to be arm's length, it has to be legit. Right?
Can I ask a question?
Sure, please.
If you're taking money out of paying yourself a salary, you have your own payroll company to pay your employees, can you just take your dividend out, like if it's the same amount every month, let's say it's like $5,000 or whatever it is, can you just pull that from your business to your personal, or does it have to go through like the same, like paying the tax on it through like, you know what I'm saying?
Yeah, I do. And so I don't know what the entity type you have is, but no, you don't need to run everything through payroll. So let's say you have an LLC and you're paying yourself a guaranteed payment, and you realize, oh look, I need to take a distribution. You can literally just transfer the funds from your bank account, from the entity's bank account to your personal bank account, and that is sufficient. It does not need to go through payroll.
And then just document, like this is salary.
Exactly. Yeah. That's the key is you're doing $5,000 every month, right?
Mm-hmm.
And it's it's not exorbitant based on your revenue of your company and all that, and it's consistent. It's the right amount, it's not something silly. It passes the smell test. And that's really the key. So the same thing with the loaning, money back and forth. You need to just, again, document. I mean, I see a lot of people, they're like, okay, I'm getting this business started, I'm gonna loan the company $250,000. Well, where's the promissory note? Right, where, how is this documented? Where is it written down? And he's like, well, you know, I'm a single member LLC. Why do I need to document a loan that I made to myself? You didn't make the loan to yourself. So Tom's going to discuss more about how the loans work and also whether that loan should be an investment into the business instead of just a loan.
Okay, one other question.
Sure.
In terms of formality of keeping the records in, we'll use internet and gadgets, and so would emails or you're actually approving action be enough to support your decisions, or do you have to go,
Well, it depends on what kind of decision it is, and it depends on what your operating agreement says.
well,
So, you know, there's also, I mean, if the operating agreement says, you know, actions by the members are sufficient if approved, you know, email is a type of written action in lieu of a meeting or whatever, if it says that, sure, absolutely, that's fine. But if the, you know, if the operating agreement says this action must be approved at a regularly noticed meeting of the members, then you can't just shoot out an email and say, hey, can I pay myself 50 grand this week? Right? That's not going to work. It depends on what the operating agreement says. So as long as you're following the corporate formalities set forth in the document, you're good to go.
So I don't know about you guys, but Robert scared me pretty good right now. I got to make sure that I'm doing everything right, playing by the book. I don't want IBM coming after me for taking out distribution or improper paying myself. So, question then becomes, how do you pay yourself correctly? How do we do this? Well, a little bit depends on what entity type you have, because the entity type will dictate how you should be paying yourself. So for your LLCs, you actually cannot pay yourself a W-2 salary. It's against the rules. So you have to pay yourself what's called a guaranteed payment. Now, if it's just you, a guaranteed payment might not be necessary. But if there are more than one members, and a great example is, let's call it a two-member LLC, Robert and I work every day, 5 days a week, I put in 40 hours, and you know, I put my investment in, and Robert just put an investment, and he doesn't really do much. He kind of just sits on the backside and collects a check. Well, it doesn't make sense that when we split the income 50-50 because, well, he's not doing anything and I'm putting all the sweat in. So what we can do is we can pay myself a guaranteed payment, and that's just basically, hey, we recognize that you're doing some effort and that this shouldn't be split 50-50. Him and I can agree on what that number should be. We will document it appropriately and put it in either the minutes or however we're going to do it, and do so accordingly. So that's how you pay yourself on an LLC. Your guaranteed payments will not have withholding, and they will be subject to self-employment tax. That's a really important point. You don't want to get to the end of the year and have a big tax liability come up. So make sure you're making your estimated payments appropriately. If you're an S corp, IRS actually requires you to pay yourself on a W-2. You must take a salary as an owner of an S corp, and you have to pay yourself a reasonable salary. So what's a reasonable salary? That's a really good question. I never know, there's no true answer to that because every industry is different, and as a planning technique, you want to pay yourself as little as possible in an S corp because you want to try and avoid those self-employment taxes. That's something you're going to have a conversation with your CPA about, but what I would say though is you would probably want to look to other individuals in your same industry and kind of say, okay, well, what is this person? What is the CEO of a manufacturing company of this size getting paid? That will be kind of your baseline for what you may or may not want to pay yourself. Corporations, very straightforward. You're going to pay yourself a W-2 wage, and that's just going to be what it is. Same as if you're working for IBM. Very straightforward. So then we get to distributions because your salary is not enough and you need to take a distribution out of the company. And distributions are as simple as, dang, that's not that simple, is it? They seem very straightforward, right? There's money in the company, I can take that money out, I'm the sole owner, I can just pull it, that's mine. Not necessarily. There's actually a lot of rules in this. I kind of referenced it earlier when I was talking about you have that skin in the game. So there's this calculation going on behind the scenes, both in LLCs and in S corps, that basically say, look, you can't take too much out, and if you do, it's going to be taxable. So when I was saying that generally distributions are taxable, or are non-taxable, I'm sorry, they can be taxable if you upset this formula. Now I'm not going to go into it, but that is something you, again, need to be cognizant of. Unfortunately, I've had some situations where some of my S corp clients saw that there was money in the bank, assumed, hey, I'm 100% or 50-50 owners, we've owned this whole thing, there's nobody else, we can take the money out because that's our money. Well, didn't work out so well, and they actually created a taxable distribution. So that's something you want to be cognizant of.
Is that typically when you're taking equity as negative that you have it, or is it a lot more complex?
That could be a situation. What more often than not happens is, let's say you have an S corp, and you started first year, you put $10,000 into it, and then you have the S corp go get a loan from the bank, and the bank loans the money directly to the S corp. What's actually happening there is that your skin in the game is still only that $10,000. That $50,000 is the company's money, not yours. So let's say you run a $20,000 loss in the first year. That means $20,000 of loss theoretically is allocated to you. However, because you only put in $10,000, you don't get to take that other $10,000 loss. That sits as being suspended. On top of that, let's say you also take $5,000 out in distributions. Well, you burned through that first $10,000 of skin in the game when you were allocated $10,000 of loss. Now you've taken a $5,000 distribution. That was really the company's money. And so that becomes a taxable distribution to you. So that's the classic example, is someone with an S corp taking out a loan from the bank and thinking that was actually their cash and it's not. So that's something that I think happens the most often. It does happen with LLCs a little less often because the LLC rules are generally a little more lax, and you do get credit for the amount of money that is borrowed from the bank as long as you personally guarantee. The personal guarantee does not work for the S corp. You can personally guarantee all day long. You don't get the benefit of that being considered kind of like loan money. So distributions, not all that simple. You got to be cognizant of them because they can come back and bite you. So we've talked about a lot of things so far. We've talked a lot about getting a company up and running. You know, what's involved, what you should be thinking about. If you have more than one owner, how do you pay yourself? So now we've got this thing up and running, and now we want to discuss, okay, now it's a well-oiled machine. Let's talk about some midlife operations.
So I'll try to be a little less gloomy in this part here. You're up and running, right? How do we take it to the next level? How do we keep things operating properly? And then how do we move from there? You know, you may be sitting here listening to some of this pass-through, non-pass-through talk and thinking, wow, I'm in the wrong entity right now. Well, if that's the case, don't worry, you can switch your entity, right? It's a relatively painless process to go from an LLC to a corp or from a corp to an LLC. So if that's something that's crossed your mind, don't worry, that's something you can handle. Next, this is actually one of the simplest things, but most people trip up on this more than anything else. There's something called a statement of information. Because California Secretary of State requires this to be issued either once a year or every other year based on what kind of entity you have. It's just a one-page document. It has the corporation or the LLC's address, its managers, and its agent for service or process. It's a real simple form. Has to be done if you have a corporation once every year or when any of that information changes. If you have an LLC every other year or when any of that information changes. If you don't do that, the Secretary of State will suspend your company's right to do business in the state of California. If you continue to operate business while you're suspended, it's technically a misdemeanor criminal offense. So you don't want to get, no one ever gets prosecuted for it, and it's really easy to get unsuspended. But just don't do it. It's just a simple little one-page thing that doesn't require any input other than writing in your address and who your managers are and your agent for service. But it's a dumb little thing. Just pay attention to it. As you start to hire employees, this is really important. You need to have employment policies and you need to have an employment manual. Even if you only have 3, 4, or 5 employees, it doesn't matter, right? You need to have the company's policies written and signed and acknowledged by the employee. And why do I say that? You get hit with some sort of, wrongful termination claim, working off the clock, or sexual harassment, right? Or discrimination. What's the first thing I'm gonna ask you? I'm gonna say, well, what's your policy on sexual harassment? We don't sexually harass, hopefully that's the answer. Well, where's the policy, right? Like, oh, we don't have a policy, right? But that's the first piece of evidence we show is, look, everyone signed a thing that says they won't sexually harass their coworkers, or they will not discriminate based on race, gender, sexual orientation, disability, blah, 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 blah. It sounds silly, but it's a great piece of evidence that we use to then counteract those kinds of lawsuits. So, get an employment manual, get these policies down, and then and even if you already have employees and you institute these after the fact, have your current employees sign that document so that the record is there. Also, discipline. Discipline should be documented, and I know a lot of you are trying to do the right thing. You don't want to put it down in their file. You're like, look, we'll just have a sit down. I'll tell them what they did wrong, and I don't want to put it in your file. It feels so much more punitive to do that. I'm sorry, but you got to do it, right? Why? Well, when that person gets fired eventually because they continue to be a bad employee, and you fire them for cause, then they sue you for some sort of discrimination or wrongful termination, and you say, well, no, I fired them because they were an idiot. The response is, well, show me the employment file. Show me the employment file for this person and show me why they were an idiot. Oh, well, it was all oral warnings. It's just not going to work. Two examples is very recent. One, where there was an employee who had a routine and a constant history of problems with customers and problems with management. She was fired. Turns out she was 5 months pregnant. Comes around and just says, oh, I was fired because I'm pregnant. Had nothing to do with that. She was a terrible employee. But again, it was all oral warnings, and that was an issue that had to be dealt with. Another example, very similar, had a person who was, routinely had problems with management, with coworkers, with being on time. But again, it was just all oral warnings. Got fired. Turns out the person had cancer. Well, you fired me because I had cancer. No one did. No one even knew. So, again, it comes back to the point of just document it. I know you're trying to do the nice thing, but let's do the right thing. And then, moving from employment issues, just general contracts. And I grew up here. I was born and raised in Santa Barbara. I know the mentality here, but it's the 21st century, and the idea of doing a handshake deal, I know is very attractive here. Don't do it. Don't do it. 90% of the time it'll turn out okay, but that 10% of the time where it doesn't, it's gonna sting you bad. And like I said, I know the local mentality, I grew up in it, but it's just, in this day and age, we can't be doing handshake deals anymore. The price is too high. And then lastly, I talked about this a little bit earlier, but get the proper insurance, right? Talk to Susan, make sure your business has the proper insurance in place, not just the proper type, but the proper amounts. Your business might have, you might have had a policy that you got 5 years ago, your business has grown, your policy amounts need to come up as well. So make sure you have the right insurance. And then lastly, I think Tom's going to mention some stuff about tax, and we will send you on your way.
So, mid-life operations from a tax perspective, company's up, running, you've made your entity decision. What are some things you can think about? Retirement options. It's good for a couple of reasons. One, because you probably want to put some money away for yourself, but also it's attractive, a benefit for employees. This first one, this self-employed pension, SEP IRA, these things are incredibly powerful. If you have a single owner entity, whether it be an S-Corp, LLC, or you're just a sole proprietor, you can really do yourself a lot of good with that. There's a lot of money you can put away in any particular year, but it doesn't necessarily work if you have employees as well. It means you have to contribute for them. All of a sudden, oh boy, I have to contribute quite a bit for them as well. So those are, like I said, for individual single owner companies, those are great. Simple IRA plans, these are great for your small to medium sized companies. They're great because they are not too expensive to administer. You can still have all your employees participate and make contributions, and there's a matching provision there as well. So again, those are good for small to medium-sized companies. Not so good for big companies. They are going to be looking more towards the 401k plan. Those 401k plans can be very expensive. Administering, I'm going to recommend these for medium to large size companies just because there's so much overhead involved in administering them that you've got to kind of have the wherewithal to be able to afford one of those. But yeah, a lot of overhead. When you hit 100 employees, I don't know if anybody here has a 100 employee company, you will be required to have an audit performed on your 401k plan, and those generally run $7,000 to $10,000 on top of everything else. So really think about whether you want one of those or not. Financing options. So your company's up and running, it's doing well, you maybe want to expand. This is something that I think is really important too to think about, especially for your small to medium-sized pass-throughs, is minimizing tax versus bankability. Okay, well what does that mean? So a lot of times when I'm working with my clients, we are hyper-focused on reducing taxable income, right? We want that low taxable income, we don't want to pay a lot of tax. The inverse side of that is when you go to get financing, the bank is going to look at your financials and be like, boy, you don't have a lot of income on here. We don't necessarily want to lend to you. So, oh shoot. Classic example is I worked with a husband and wife. They were had an LLC, pass-through entity, so all the income passed to them personally. They decided they wanted to go buy a house. For the prior 3 years, we were working vigorously to minimize. They were seriously the people who pounded on me the most to bring down that tax liability. So we did everything we could to make that number as low as we possibly could. They go to get a home loan, and they basically had trouble qualifying for almost anything. And they're like, well, what the heck? What's going on? Well, it's because we drove down the taxable income so low that nobody wanted to lend to them. And that exact same thing can happen in your business. If you're driving the taxable income so low that when a bank comes in and looks at your financial statements, they're like, yeah, no thanks. So you have to be cognizant of that, especially in the long term. If you're thinking, hey, my company, we're going to want to expand, we're going to want to open a new whatever, we're going to buy this machinery, whatever it is you want to do, you got to think about what the impacts are from both perspectives. So sometimes you might want to leave some income on there if you are wanting to do this financing. Now, that mostly applies to your larger banks. Your larger banks are going to want to put you in a box. They're going to be looking. They look at your K1. They're going to say, okay, these are the numbers. Da da da. Some of your smaller banks might be able to look around that. They might be able to say, look at you on a global perspective. Say, oh well, I can see that they're doing this, and have they not done this, they might have been in a better position. But that's just something you want to be thinking about if you're considering taking out loans and needing to finance. So, and then the other thing is just missed deductions. Are we picking up everything on? Are we going into the deep bowels of the IRC, the code, to make sure we're picking up everything we can? Some of the interesting stuff is DPAD, R&D credit, and hiring credit. So that's some interesting stuff that's going on there.
What is DPAD?
Domestic production activity deduction. Basically, if you are manufacturing something here in the United States, there's a potential to take a deduction. I don't want to go into the mechanics of it, but it's really powerful. It can be up to like 9% of your qualified production activities income. I'm sorry, I hate to use all the high-tech words, but that's one that I think people miss out on. I think there are companies out there who are not taking advantage of that. That and this R&D credit thing, we've had companies who were clearly R&D companies come in and say, we ask them, hey, well, what R&D are you doing? Oh, well, we're not doing any R&D. We're just doing experimentation. Oh, interesting. So why do you think it's not R&D? So what you would do is you kind of go in, you look at what they do an analysis of what the company is doing and see, hey, can we fit you into any of these things? So that's one thing you want to be thinking about. It's not just going to your accountant, putting numbers into a box, and then spitting out a return. It's sitting down with them, understanding what the business is doing, how it's operating, and what things you can try and take advantage of. The one thing that drives me crazy is when my client comes to me and we're already past year end, and he's like, okay, well let's reduce my tax liability. I'm like, well, there's not much I can do. We're doing your tax based on last year. The key is you go in September, October, November, you go talk to your accountant like, okay, here's my projection so far. What are we going to do? How can we if you want, minimize your tax liability, or just understand where you're gonna land so there's no surprises, right? You go in, you get a projection going, you figure out what your tax might be, say, oh shoot, you know what? It looks like I'm gonna owe an extra, $3,000 or $4,000 come April time. All right, I can plan for that, I can handle that, I can save that up. It's a lot harder when April 15th I call you up and I'm like, hey, so you owe another $5,000, and you're scrambling to go find that. So I know I've gotten a little off topic there, but that's something you should really be thinking about as business owners is how in touch are you with your CPA and your attorney, and am I taking advantage of everything that I can? So, having said that, don't let the tail wag the dog. What does that mean? It means don't make business decisions based on the tax. First, make good economic decisions and let your CPA help you fit them into the tax benefits. Too often I see people coming and saying, well, let's do this because it's got a good tax outcome. Let's do that because no. Does this make sense from an economic perspective? If that's true, then we'll work the tax side. You run the business, let us do the taxes. Anyway, so having said that, you can see how the attorney, the accountant, the insurance, the IT, they're all interplay with each other, so the big key is bringing everyone to the table.
And I think unless anyone has any questions, I think we are done.
I have one quick question.
Sure.
On an going back to the entities, on an LLC, what decisions do you need to think about regarding a member manager or being a member? The difference.
It really, from a legal standpoint, it makes no difference. You could have the manager also be a member, or you can have the manager be a person who isn't a member.
And you can have multiple managers.
Correct. You can have a single manager, multiple manager. You can do whatever you want. I mean, it really makes no difference. Yeah.
For a single owner entity, what additional protections does an LLC have over a sole proprietor?
I mean, I think basically everything we just talked about. When you have that entity, you get that liability protection. When you're a sole proprietor, it's you. You are the business, right? Whereas when you're the LLC is the business. You just happen to be a member of the LLC and its owner. So in order to get to you, that corporate veil has to be pierced. But when you're a sole proprietor, there's no barrier. It's, I'm coming after you.
I think to put it a little similarly, it's whatever assets that are in the LLC are subject to whatever liability there is. So someone can come, they can take all the assets of the LLC, but if you still have that corporate veil, they can't come after your house, your car, your whatever it is, the portion of the garage, whatever it is. They're stuck at the LLC. Those are the only assets that are subject to whatever legal is going on that perspective. When you're an individual, yes, you are 100% liable, but the idea is that you have coverage that should cover any major thing. I mean, I don't know, I defer to Robert, but they potentially, if you run out of coverage, then they can come after your personal assets. So it really, like I said, puts up that line, divides you, those assets that are in that LLC are subject to whatever they want to go after, and you could potentially lose them, but then it stops there, and they can't come for your house, your car, your bank and wages.
Yeah. Go ahead.
So, given the disadvantages of a C Corp, under what circumstances would it make sense to convert to a pass-through entity? And what are the implications of doing that if you're contemplating a sale of the business?
So that brings up a real important thing. The C Corp, and Tom briefly touched upon that, but we see the C Corps utilized when somebody comes in to do a strategic partnership, like a larger company wants to come in and buy. They don't want LLCs. They want a Delaware C Corp every time, right? So if you're contemplating that, if that's on the horizon, it might not be the right time to do. If that's the exit strategy, is sell to somebody bigger, they're not going to want to buy from an LLC, right? They're going to ask that you, as part of the deal or something, it would make the deal more complicated. So if that's on the horizon, at least I don't know what Tom's position is, but I would suggest you stick with the C Corp. Unless you're selling it to like another peer.
That's
but
what
okay.
it would be, is a sale to others.
Okay, well, in that case, then yeah, you can go through the conversion process and take advantage of the pass-through. But if the idea is to bring in any
heard that if you do it too close to the sale, there may be some implications.
Sure, of course. All those things, again, we go back to the smell test, right? If certain material actions start to take place close to a material transaction, then yeah, that's going to be looked upon, and it'll probably give him a heartburn and a headache every which way, and it'll also cause the people on the other side, the buyer, their CPA, their lawyers, also the same sort of heartache and or heartburn and problems as well. So yeah, that's if you're close, you might want to leave things as is, but if you're talking a couple more years that you're going to have to deal with the non-pass-through issue, then it might be beneficial to investigate that. Down there.
When it comes to making switches between corporations types or entity types, does it matter when in the year you do it or any time before December 31st counts?
That's a Tom question for sure.
You can pretty much do it whenever you want. Ideally, though, you're going to do it at year end. It just makes it cleaner. Otherwise, you're going to have multiple tax returns. You're going to have, let's say you go from an LLC to a corporation. You're going to have a part-year LLC and then a part-year corporation return. It's just really clean when you do it at year end.
So if you're thinking of doing it in this month,
That would be a good idea, yes.
Question regarding liabilities. So, I'm the CFO for multiple entities, and in certain entities, we have some aviation equipment. So your story about the husband and wife kind of rang through. And in this situation, we also have a piece of aviation equipment that's out on the charter certificate. And so, as a vote of additional protection, not only have I asked for additional insured at the entity level, but also at the trust level. And the entity is a pass-through, it's an S corporation, or a pass-through to the trust. Beyond providing additional insured, beyond maintaining a corporate veil, are there any other recommendations? Because, you're a lead lawyer, and I've been involved in the legal discussion.
Sure.
And here's how it goes, is there's a quick asset search, and if you find there's money, they're going to do everything they can to attach any affiliated, whether there is or is not a corporate veil, and then I now have the obligation of providing substantive evidence that there is a corporate veil and these assets are outside of it or into it. What other recommendations would you have, number one? And then number two, am I doing myself a disservice by providing the shareholder or the sub-S owner as an additional insured on the policy because we're at a negative instance?
Yeah, that's actually,
Do you understand where I'm
I know, I do, and I'm kind of, this is gonna sound a little counterintuitive, but naming shareholders as additional insureds, that's interesting because,
You understand my objection?
yeah, you're trying to protect them in the event somebody goes after them. But then at the same time, that perceptually shows that
Correct.
we're the same and we need the additional protection.
Right.
That's, I haven't thought about it that way.
Can I interject something?
Yeah,
As an insurance?
yeah, as an insurance
As an
person.
insurance broker?
Yes.
The named insured includes the entity, but inside the definition of who is an insured
Yes.
includes
Shareholder.
the shareholders.
So,
So there is not necessary to name them individually,
okay.
as long as they're in the business, operating the business.
Okay, passive versus active, any concern to you?
No,
Okay. And that's a insurance
insurance,
definition?
yes,
Okay,
yes.
got it. Thank you.
And then I think that right there is a great example of why we formed this group, was that these kinds of things, it crosses industry line all the time.
Sure.
And having left hand talk to right hand solves those kinds of questions.
Got it. Thanks for your feedback.
So I think with that, hopefully we'll see some of you next month, the next program, and then you'll be getting invites from people who invited you to this one, and then we'll go from there.
And also, everyone should receive we'd like your feedback. So you'll be getting an email from us, and we appreciate any feedback. Thank you.
Thank you, everyone.